Welcome to OCBC Research Insights. Today we have Selena and Terence joining us today to talk about inflation, and what it does to asset markets globally and within the emerging market space itself. Now, Selena, we keep hearing this term, stagflation. Stagnation plus inflation, essentially characterizing the fact that growth might be slowing down at a time when inflation is picking up. Not so good to happen, but do you think that will actually be happening over the next 12 months or so?
Well, as far as inflation is concerned, we are having an almost perfect storm due to both supply side and also demand side factors. On the supply side, we see supply chain disruptions, port congestions, and also on the demand side, because of the economic recovery, especially in China, commodity prices have been rising. So net, we are actually seeing that inflation is staying elevated for a more persistent period of time rather than being transient as what most of the central bankers have hoped for. I think going ahead, it's going to be still very dynamic and very fluid, but I think the situation is one where we will see 2022 as growth normalizing back to trend levels. So if you look at the two major economies, the US and China, US growth is going to slow to around 4%, and China's growth will average around 5%. So yes, there is a growth slowdown underway, but I would hesitate to call it stagnant growth. So our baseline view really is that there is going to be more protracted inflation, but not quite stagflation.
I see. It looks like between stagnation and inflation is still the greater risk. And in reaction to that, we have seen market pricing in potential for 1 to 2 rate hikes from the Federal Reserve next year. Occurring at a time where the FOMC members themselves are saying, not quite, we're not going to see rate hike yet. How do you see the dichotomy between what the market is expecting and what the FOMC members are telling us?
Well, financial markets are always forward-looking, so they try and look ahead and think of what the Fed will do after they actually complete the taper of its bond purchase program. And they are actually right to a certain extent to speculate on the timing of the Fed rate hike. Because if you look in terms of even the dots plot by the Fed, they are evenly split between hiking in by the end of 2022 versus delaying the hike to 2023. But I think if you look in terms of the growth for the US economy and the fact that inflation is proving to be a lot more persistent rather than transitory, I think financial markets are right to price in and front-load the risk of a rate hike next year. So my personal view is while the situation is still very fluid and dynamic, I would be leaning towards the view that the Fed may actually embark on its first rate hike by the second half of next year.
I see. Now, Terence, within that space of looking into the rates outlook for 2022, and the fact that as Selena mentioned, the Fed won't be hiking too quickly, how do you think that will impact on the FX space, especially on the US dollar?
We think that the US dollar will still be the foremost currency amongst the major currencies, and this will be the case so long as the Federal Reserve remains the most hawkish amongst the major central banks. This is contrasted with the almost ever dovish European Central Bank and the Bank of Japan. And this gives us a structural reason to be backing the US dollar against the euro and the yen. For the Reserve Bank of Australia and the Reserve Bank of New Zealand, we find that they have more room to lean hawkish, and as a result, we think that the Australian dollar and the Kiwi dollar will have more scope to be resilient against the US dollar. The other thing is that the US dollar continues to be the predominant haven currency. With higher inflation and also growth starting to slow down, what we cannot rule out is this increase in investor jitters and risk-off sentiment. And that in itself should be supportive of the US dollar as a safe haven currency.
Now, let's assume the stagflation story turns out to be true, i.e. the central banks turn out to be wrong and rather wrong on that. How do you think that story would change in terms of the FX space?
Yeah, I think the key unknown here is how serious the stagflation situation will eventually become and how that would eventually impact the central bank's rate hike trajectories. In itself, if it does not change the rate hike trajectory, we can still expect to see the dollar being supported. However, if the central banks chicken out and they start to reverse on their rate hike trajectories and start to talk about rate cuts instead, then we will need to reassess our dollar analysis, and at that point in time, we will have to have a complete reassessment in terms of which central banks are most trigger happy in terms of monetary stimulus and which are more confident about their domestic macro situation. That in itself will have a subsequent impact on the FX space.
Now, Selena, moving on beyond FX, what do you think will happen to the other asset classes in these alternative scenarios?
Well, I think the main point to take away here really is that the US Federal Reserve is not the only central bank that is turning more hawkish and talking about tapering bond purchases or even embarking on rate hikes. So in general, we have seen the recalibration in a lot of the global bond markets. I think going ahead, what we want to look out for really would be that whether the narrowing yield differentials actually puts pressure on portfolio inflows into emerging markets, including Asia. And we're starting to see some signs of that. I think if you throw in idiosyncratic risks, like the whole China slowdown story, they have basically a common prosperity objective, so they are increasing regulatory scrutiny. On top of that, they have property market downside risk as well. So there is quite a bit of concern about what this would mean for growth in the region and especially for Asia as well. So I think going forward, we are in probably for more bouts of volatility. It could be a fairly challenging time for risk. I wouldn't rule out the possibility of policy missteps in this kind of environment. And what that would mean is that you have to brace yourself for more financial market volatility ahead.
Well, as Selena mentioned, brace yourself for volatility, and a lot of this volatility, as the two have discussed, really predicated on how inflation will turn out to be. Well, with that in mind, lots to digest. Thank you for your time. Until next time.